Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking US financials with John Stoltzfus, Chief Market Strategist at Oppenheimer Asset Management. The S&P 500 has gained about 3.5% since Donald Trump was re-elected president, as investors bet on lower regulation and possible tax cuts. And perhaps no sector is keener on potential reform of the regulatory system than financials. The S&P Financials Index had gained 7.1% on Wednesday morning since the close on November 5th, as the sector lobbies the incoming administration with a wish list, including lighter oversight from the SEC and lower capital requirements. Well, for more, I'm joined now by John Stoltzfus of Oppenheimer Asset Management. John, hi. Thanks for joining us. Why are we seeing this run-up, particularly in financials then? What's got the sector excited?
Well, Elena, I would have to say that the financials really have a break here in terms of the election of Donald Trump on a very decisive election. It would appear to be that regulation, which has been impeding the progress of the sector of late, it would have a good chance of being reduced significantly.
As you mentioned, banks have a number of demands for the incoming administration, including laxer capital requirements and less stringent stress tests. What would that mean for the sector if those things happen?
Well, I think what it would mean, it would really, what it will facilitate is increased profitability. And I think the process of an improved economic landscape with less regulation will also elevate the opportunity for doing deals in M&A, consumer lending, a variety of things. Also, if we look at it in terms of performance, it's the second best sector in terms of performance since the election. It's the third best sector since the beginning of the year. So things have already been improving.
John, if we might see more banking deregulation under a second Trump administration, it's not so long ago that we were worried about the collapse of some of America's smaller banks, is it? So is there a risk there?
Well, we would certainly have to think that there would be a risk on a basis of perhaps some individual banks that would be more aggressive as a result of less regulation. But we must say that the concerns that we saw about a year ago when we had banks on the West Coast and on the East Coast of the U.S. get into trouble, it was really idiosyncratic in nature. And it appeared that the banks, from what we could tell, the banks that were involved, it was basically a failure of portfolio management 101, so to speak, as if it was, freshman year in college at university. And the thought is that essentially what they did is they took in short-term deposits or short-term risk and backed it with long-term debt that was at historically low interest rates. That's why we say it's a failure of portfolio construction 101.
One thing we do know about the investors and financial decision makers close to Donald Trump is that many of them are huge fans of crypto. What does it mean for the wider financial sector if promoters of cryptocurrency arrive in the White House?
Well, Elena, we've never been fans at Oppenheimer of crypto. From our perspective as strategists, we just don't see any fundamentals in there. If anything, we would say the blockchain mechanism seems to have many applications that could be good. But regrettably, the founders of Bitcoin did not patent the blockchain mechanism. And so the idea of Bitcoin as currency or as some kind of a surrogate for moving money around the world is gaining popularity, but it concerns us here at Oppenheimer. So we don't think that would be something that would be within the course of the next 2 years to be something that would hurt the banks, but certainly could be a thing that might cause increased volatility as we go forward beyond that point.
We do expect, though, John, that his plans, including tax cuts, will move the fiscal deficit higher. So what would those borrowing costs mean for the banking sector?
Well, the relative cost of what that would do for the sector, where interest rates are going. Curiously enough, where the if we look at the 10-year Treasury yield, which is the yield that is most prominent when it comes to setting mortgages and many other rates. It's a benchmark rate, and it's priced by the market. We have to say this looks more from a historical perspective to us. As you know, I've been in this business for 41 years. It's more of a normalization of interest rates, wherein you have a situation where bond issuers now have to pay for the privilege of borrowing money once again, which when we had emergency levels at the Fed funds rate 0 to 0.25, we eventually had rates in the 10-year that actually, as I recall, reached about 0.5% at one point in 2020. That's unrealistic. Free money, we don't think is a good thing. The end of free money, we think, is a good thing for depositors, bond buyers, and for business that will likely become more responsible.
John Stoltzfus of Oppenheimer Asset Management, thank you so much for joining us. Well, that's our roundup of the US financial sector. I'm Elena Casas, and this is Reuters.